We like to recap the year, end of 2022, rolling into 2023. What do you remember?
End of 2022, rolling into 2023, this onslaught of interest rate increases was in full effect.
Full effect.
And everybody still had the memory of interest rates that might have been in the 3% or 4% that were early 2022. They still had those memories there. But what they also saw was 4, 5, 6, 7 straight increases of the Fed funds rate by the Federal Reserve, which indirectly raises all of our interest rates on the rental properties that we invest in and other investments as well. And so that was the theme. It was like, oh man, let's say uncle right now at the end of 2022 and 2023, yeah. when people thought about how much interest rates were rising, they were getting into the 5s and into the 6s and a little bit higher. And people are like, I can't take anymore.
Yeah.
I can't take anymore. That's how the year started in 2023.
Yeah, I would say the dominating story of the year is the interest and interest rates.
Yeah,
Like,
very good. See what you
people,
did there.
yeah, you like that? It has been the thing that started the year, and it's been the thing that's really dominated the year. But I remember that it was doing that at the end of 2022, and then 2023 started, and I felt like there was if I'm not wrong, there was a small dip in interest rates, kind of like by the end of the first quarter.
Yeah. And I think it messed with everybody's mind because as people were saying, I can't handle anymore, as interest rates were going up and up and up, there was a brief drop in interest rates. And don't quote me on it. It was somewhere end of January, February timeframe somewhere, and interest rates actually came down. And we did a lot of discussion on how interest rates can actually come down even if the Fed doesn't drop the Fed funds rate. So we did a lot of education on that. And what happened there was mortgage applications went through the roof. Buying went back up. There was a lot of demand, and that's what happens when interest rates come down a little bit. Demand for housing went so far up, but that didn't last.
Less just a blip on the radar.
That was just a blip
when that first started. And it just kind of reminds me of where we are right now to a certain extent, right? Because we've had another tick down, and we're going to talk about that in a second. But secondary to interest rates, I think interest rate was the headline, but the reason why is because of people's fascination with pricing, right? And like these like headlines saying interest rates are going to go up, there's going to be a new housing crash. That was kind of the other overlying thing that we had to speak of often. And I think characteristically to this show, because we don't have average takes out here, you've been holding the fort saying that, yes, interest rates are dropping. It's going to reduce demand, but the supply dynamics are such that pricing are not going to, there is not going to be a crash because of the supply side. Tell me about kind of like pricing in the story there.
It was a lonely place.
I was here.
It was a lonely place. You were with me. You're right. It was still lonely to be one of the only educators out there saying that there was not going to be a real estate crash in 2023. Now the articles that are coming out is the real estate crash of 2023 that never happened. But, if you asked anybody on the streets in the beginning of 2023 and going through 2023, if there was going to be a crash, everybody was, of course, expecting it. Articles were written, talking heads were talking a lot about it. But we sort of, in our own little corner of the internet here, we came forward and we said that was not going to happen. And here's why. It's because even as interest rates continued to go up and up and up, as we said that they would, as the Fed continued to raise the Fed funds rate, we knew that that is only controlling the demand side of the equation. There's this whole other side, which is the supply side of the equation, and supply and demand affect pricing. And on the supply side of the equation, we are way undersupplied in terms of housing across the country and in most markets, and definitely in Jacksonville. And we have talked about this, we measure it, we report on it often. And we just said, guys, what this is going to do is it's going to create a high floor of pricing. And you're not going to see prices come way down just because there's not enough supply. And that's what we've seen. So now everybody's like, I don't understand why this can't happen. But it's been real simple. I mean, we continue to talk about the same simple metric over and over and over again when it comes to supply. What's that?
Months of inventory.
There it is.
MOI.
So MOI, months of inventory. So, while interest rates went up higher than everybody thought they would, we all thought they were going to go up, but they went up higher than we all thought they would. They got close to 8%. Home prices continued to actually either stay flat or go up. They're up year over year in Jacksonville. And nobody else saw that happening, but that's what we said. And it was because having the experience to know that this isn't our first rodeo and understanding that we can't just go off of the headlines. We have to look into the metrics behind both the demand side and the supply side. And so ultimately what we've seen is that even though home price affordability is a challenge, you've continued to see home prices tick up in many markets across the country, Jacksonville being one of them. Rent prices year over year have ticked up as well. And that's because of the housing shortage, which is not going to be solved anytime soon.
Yeah. And that's been really the through line of the year. It is interest rates going up, fear of interest rates going up and how that's going to affect the pricing, and yet pricing staying stable while interest rates continue to go up, and this housing class continuing to show how resilient it is. At some point in the year, we found a pattern that we could match to, right? Like everybody wanted to go back and think of the last recession, but the last recession was not one, as similar in the conditions. At some point in the year, you dug this up, and it was this idea that if we want to talk about cycles and we want to look at similar moments in history, it wasn't 2008 you go back to, it was 1981 you go back to. You want to tell us about that, GC?
Yeah, absolutely. There are so many similarities between what happened at the end of the 70s and early 80s in comparing that to what's happening now in this housing market. And what ultimately happened is the Fed raised interest rates up considerably at the end of the 70s and into the early 80s as a way to tame down inflation. And what that did was that softened housing demand. But guess what? Housing prices didn't drop. They actually went up a little bit in those years where interest rates went up so much in the early 80s, which is shocking to many people.
Which is shocking to me.
And then the next thing that happened is, guess what? The Fed at that time dropped interest rates, get them to more normal levels. And when you drop interest rates, the asset class that responds the most favorably in terms of price appreciation would be housing. And so what happened in the early 80s, as those interest rates came down, home prices actually went up at a rate that was higher than expected and higher than average at that time. And so if you start to draw the parallels here in 2023 and getting into 2024, the Fed raised interest rates faster than any other point over the last 40 years in 2023. Home prices did not drop. They did not go down. They actually held firm. And then what is about to happen is the Fed will be dropping interest rates at some point. The Fed will be dropping the Fed funds rate. You're already starting to see interest rates go down. And when you see that, you start to see mortgage applications go up and more buyers come into the marketplace. And what we expect to happen is that this is going to be a catalyst for home price appreciation. And so we expect to see significant home price appreciation over the next 3 years. I don't know exactly how it's going to happen or when it's going to happen, but I know that what you have here is you're going to have a bump to demand because interest rates are going to go down at some point, and you still have an undersupplied housing market. And so that's why this show is about showing you what's going to happen before it happens. And that's why when people are saying, hey, when's the best time to buy real estate? Well, it was, yesterday. Right. And right now, the opportunity is to buy in before interest rates go down dramatically because we see home prices starting to appreciate as that happens.
Yeah. And we're got an upcoming show on doing the math of exactly what I'm about to talk about here. But our thesis throughout the year, right, as this year has developed, we've taken the brunt of interest rate raises. We have shown that pricing has stayed stable / gone up a little bit. And we have seen what happens when it bumps down. Right. And we can also look at historical comparisons of as an economy, what it looks like the 80s. And our overall thesis for the year has essentially been the idea that people are asking themselves the question, okay, so do I buy now and lock in, what I've got and then ride the wave up and refinance later? Or do I wait to buy when the interest rates go down? There's maybe a little bit more cash flow in the first couple of years, but you're also going to buy at a higher price, even though it's a lower interest rate. So you don't really know exactly what's going to go on. And we're going to go deeper into that. But our overall takeaway, our belief is the idea that you are best served to not wait to buy real estate, but to buy real estate and wait. Meaning, if you get in now, you are locking in today's price point, and today's rate, right? But the beauty of it is that in the near future, when interest rates go down, you will have the opportunity to refinance. You keep your price, but you date the rate, right? So like you drop that rate, it will increase cash flow. You get to, cash out on that appreciation that's going to happen, as opposed to just sitting with money on the sidelines that you don't know when that rate is going to go down. And more importantly, the moment that that rate goes down, you're immediately paying the premium on price forever, as opposed to temporarily, which you do with rate. Did I get that right?
Well said, brother.
Okay, cool. And, anecdotally, that's kind of been my story. My wife and I were waiting to buy our primary home. We decided to invest in a duplex right now that interest rates just blipped down. And wouldn't you know it, this duplex that had been on the market for the last 6 months, interest rates dipped. We put an offer in on it, and I was immediately competing for another offer, right? So this idea that it's going to get harder to buy, if you were with us before when, inventory got really, really limited, that's highly likely. So it's better to buy now with open eyes, not a buyer's frenzy, lock that in, lock in that price, and then refinance later.
I love it. I love your personal story too. It's what's happening.
That's what's happening. So that is our year-end review, GC.